Hello, investors, and welcome to Stocks to Watch. I'm Ashley Berry, and this interview is being disseminated on behalf of goldstockdata.com. Today, we're taking a closer look at the extraordinary volatility we've seen in the precious metals markets. In recent weeks, silver dropped 10%. In fact, today, as we speak, February 12th, while gold fell roughly 10% recently. To help us unpack all of this, what this means for the broader market, and more, we're joined today by Durrett, founder of goldstockdata.com. Hey, Don, great to have you on.
Hi, Ashley. It's good to be back.
Yes, so always great to have you on. So when we see moves of this magnitude, Don, can it still be considered a pullback or a correction? I know we've talked about this, or does it indicate a broader shift in the volatility regime for precious metals?
Um, I've been saying that this is just noise. Like today, gold is down 3%, silver is down 10%. I mean, those are big moves.
Mhm.
I've been saying the S&P 500 is the most important chart for gold, and it that's the chart to watch. So the S&P was flat on Monday and Tuesday, and near an all-time high. I mean, really close. So the all-time high is about 69.75. I think closed over 6,900. Something today it dropped below 6,900. It's 68.65, down 1%.
Mm.
So the S&P just has a little 1% hiccup, and gold drops 3%, silver drops 10% in one day. That's how significant the S&P 500 is here for gold. If the S&P 500 would have been flat today, gold would have been flat, maybe even up. I really don't know why. Um, there's something to be said about these assets that don't have counterparty risk that are creating uber leverage. So you have Bitcoin down 50%,
Mhm.
and it doesn't have any counterparty risk. And then you have gold was at 5,600, and I forget how low it actually dropped, but more than 10%. It dropped 12% in October. Um, and then you got silver that was at 120 and went all the way down to almost 60. I think it was up to 63 or something. And now it's back to 80, 76. And so this volatility that we're seeing is very important. It's very significant. It's massive. And people don't really understand what's happening here. So I've been doing this for 20 years, kind of on a daily basis. And what's happening right now is literally kind of the end game scenario. And people don't realize it. So this volatility is telling you something. It's like, what's going on here? Why is gold at an all-time high? Why is silver going from $35 to 120
Mhm.
in less than 6 months? I'll repeat that. $35 to 120
Mhm.
in less than 6 months. Why? And nobody's really connecting the dots on why. And it's hard because people are used to following kind of, the mainstream media. So if the stock market is at an all-time high, everything has to be okay, right? Everything has to be fine. We got GDP at 3-4%. Everything's got to be fine. And so anybody that says anything that's outside of that, they're kind of a quack. They're like, they don't know what the hell they're talking about. Everything's fine. Everything's under control. But the more that you dig into the data and you really look at it from a holistic standpoint, and then you back up and you take it all the way back in history, and you can go, you can start in 1970, you can start in 1945, you can start in 1913, you can even go further back and you can go to 1800, and then start connecting the dots and see exactly what is actually causing gold to do this.
Mhm.
Gold does not do things like this, and silver especially doesn't do things like this. Silver is basically telling you that it's acting like a monetary metal. It's not acting like a base metal when it goes to $120, right?
Mhm.
What in the heck is silver doing here? Why is silver so excited if everything is normal, everything is fine, if you have a strong economy? if you look at the revisions, the non-farm payrolls came out yesterday. If you look at the revisions for last year, if you look at how many jobs were added for all of 25, it's under 200,000 jobs in total for the entire year. If you that's not those aren't the numbers that came out of the administration. That was revised down.
Mhm.
If you look at those numbers, you cannot say that we have a strong economy. So right there, oh, they revised down the labor force by 1 million jobs.
Mm.
It's a lot, and there's one event after another, that one data point after another, that is screaming that something's not right here. If you look at freight, for instance, if you look at retail, if you look at, what's the kind of strength, if you look at housing, if you look at employment, if you look at leadership in the market, like we've lost leadership. So, I mean, NVIDIA in the Max 7 were the leaders. They are down for the year.
Really a fascinating take, Don. So, okay, I guess I have to ask, when do we see this stop? When's it going to end? Before we continue, be sure to subscribe to our channel and ring the bell to get notified about our latest videos.
Right. You're talking about the stock markets. When is this the economy? When does it stop going higher?
Right.
I I firmly believe it's this year. And what I'm expecting to happen, you know, today's 1% drawdown, it didn't surprise me. I'm expecting volatility. What I'm expecting to happen is basically a bit of a correction in the stock market sometime February, March, April, somewhere in there,
Okay.
and over the next 3 months, some type of a 5%, say 3 to 5% correction, and then it doesn't bounce, and you get stuck in this trading range.
Mm-hmm.
And that's going to frustrate people, because right now, as we speak, the S&P 500 is down for the year, which is kind of odd. It's at 6865, and it's down for the year. So the S&P hasn't really done squat this year. It needed to get above 7,000. It's interesting. We're 6 weeks in, we didn't get above 7,000, and it's pretty telling.
Mm-hmm.
And so they're just talking about rotation, like on all these business shows. They're talking about rotation because we lost leadership with the Max 7. So they got to have something to talk about. They don't want to talk about the Max 7. Kind of cracks me up. But I think what's going to happen is you're going to get into a trading range. And that trading range is going to be the signal, if you will, the end. Because the way our economy works, you got to have growth. You got to make money. The S&P, the stock market has to go up, right? You got to make 8, 10, 15% on your money annually. And people absolutely go absolutely nuts if they're losing money, or if they're not making money, they're frustrated. That's just the nature of our economy. So if we get into a trading range, which I think we will in the next quarter, by the end of April, I think we'll be in a trading range. And then the second half of the year, I think it's going to be then we won't know how fast it will break down. That we could have a slow breakdown, but at some point this year, I'm expecting a big sell-off. It could be before the midterms, or it could be after, but I'm expecting a big one. And then that will be the onset of the end.
Speaking of sell-off, indications are that hedge funds gradually trimmed their exposure ahead of the sell-off and reallocated capital into their asset classes. So do you see this primarily as a temporary rebalancing, or really it's reflecting a more assessment, precision assessment of the risks building in the metals markets right now?
You have to understand why I'm in gold and silver.
Mm-hmm.
I'm in gold and silver because the U.S. economy has been playing a very dangerous game for decades. And that game eventually is kind of a game of chicken. Well, I don't know if chicken's the right word, but it's basically, and we've talked about basically printing money to kick the can. We've talked about it, we can't pay back our debt. Eventually it's going to bite us. So I basically came to the conclusion, if you will, that this has a bad outcome. Once debt gets too high, you can't pay it back. And once you cross that Rubicon, there's no going back. There's no solution. And that's why I own gold and silver mining stocks, for that specific reason. In other words, I do not invest in gold and silver because it's a good industry. It's a terrible business because if you find a gold mine, it only has so many years of life, and then you got to go find another one, and
Right.
it's hard to find them. It's a really terrible business, a very difficult business to make money. Plus, it's cyclical on top of it. And you got two ugly things. That's not so. I don't own gold and silver because it's a good business. I own it because gold wins
Mm.
when the U.S. basically loses its credit. Now, people say, "Oh, I mean, you go back to Ben Bernanke, the U.S. will never default on its debt." Well, that's absolutely that. Well, it's actually not true. We are going to default on our debt, but basically what it's saying is that we can always print the interest. Yeah,
Mhm.
sure, you can always print the interest, but eventually you can't print all of it, right? Like right now, we have $2 trillion in debt. Our deficit's 2 trillion, but on top of that, we keep rolling over the debt. Janet Yellen was borrowing. All the borrowing was on the short term, 3 months to 1 year, all of it, right? Bissent's been in office now for a little over a year. He's been doing the exact same thing. So we're rolling over 5 to 8 trillion, $5 to 10 trillion on top of the 2 trillion. Those are some big numbers.
Mm.
Those have to come from somewhere, and the Fed can't print it all because this is where Bernanke's thesis fails. If the Fed tried to print all that money, it would destroy the economy because it would create inflation, and that's the kryptonite for printing money, or the kryptonite for MMT is inflation will just destroy you. And that's where we're at today. And that's where everybody's in denial. Everybody's in denial that we don't have a debt problem.
Yeah, and
We're $2
speaking,
trillion. dollars. Ironically, the one person who brings this up quite often and everybody ignores him is Trump.
Mhm.
Trump basically, he says it. If you listen to him, he basically says, we got to get those interest rates down. We can't afford this. We can't afford these interest payments. All
Yeah.
right. He says it out loud,
Mhm.
and then everybody ignore it.
Mhm.
You never hear anybody saying Trump's worried about the interest payments. Is anybody else worried? Have you heard anybody? I haven't heard a single analyst say, why is Trump so worried about these interest payments?
Mhm.
It's like he's been bankrupt a few times. He understands that that's dangerous. That's the end game for the US, and we're not very far from it.
Yeah, I'm glad you brought that up. And speaking of the Fed, following the nomination of Kevin Warsh, do you think his appointment could really affect broader financial markets at this point, particularly equities and risk assets?
No. The,
No,
the Fed the Fed is
defiant.
trapped. The Fed is trapped. I don't care who's in charge.
Mhm.
There's nothing they can do here. Once you're bankrupt, you're bankrupt. You need a white knight, really. You need somebody to come in and say, "Oh, don't worry, we'll cover you." But we don't have any. There's no white knights that are going to come to the aid of the U.S. and say, "Oh, don't worry, we'll pay your interest payments for you this quarter. You're good." There's no rich uncle that's going to basically
We
write a
should be
check for the
so
U.S.
lucky, Don.
No, no, not going to happen. And so there's nothing Warsh can do, nothing Besant can do. Once once we lose the stock market. It's really interesting that I do hear quite a few analysts say that they won't let the stock market drop. They can't. I've heard this. I've heard people say this. They can't let it drop because if the stock market goes down, it's over.
Mhm.
And it's true. It is absolutely true. The stock market pays for probably 10% of the federal budget deficit through capital gains. When you're looking at $65 trillion, that's how much money is in the stock market.
Mhm.
65 trillion. It's huge. Well, just throw a small percentage on that and it's capital gains.
Mhm.
It's a huge number. The government, in other words, the government has literally become dependent on capital gains in the stock market. They're dependent on it, and say, oh, they can't let it drop. Well, guess what? They don't control it.
Mhm.
Now, sure they can. They can manipulate this, manipulate that. once this is the old Jim Rogers thing. If you think that they've solved the business cycle, I got news for you. If you you can't, there are certain things that nobody controls. You don't control the business cycle. You don't control the stock market. Those things are uncontrollable. And so that's why I mean he can't solve this because the thing that's going to bite the Fed, believe it or not, more than anything is the stock market.
Hmm.
That's going to bite them more than anything. Because once the stock market goes down, guess what happens? Corporations start laying people off.
Yeah.
And that combination is
Ugh.
it's kind of an in-game scenario. But
Yeah.
what people don't realize is that this is the wall. We've been kicking the can for 20, 30 years. We've been kicking the can. Oh, we'll just print our way out of it. People don't really look back and think in the 1980s that what Reagan did was wrong. But what Reagan did, George Bush Sr. called voodoo economics. And everybody laughed at George Bush Sr. And everybody patted Reagan on the back for what he did. When Reagan came into office, we had a national debt of less than $1 trillion. Less than $1 trillion. Reagan gave us two things. He gave us deficit spending and he gave us globalism. The two things that are going to just literally destroy America. But it wasn't Reagan's fault. That's what these economic advisors were saying that was the way to go. So I don't blame Reagan at all. I blame his advisors who basically said, this is the solution, Mr. President. And he said, okay, go with it. I guarantee you, this wasn't Reagan's idea. Go with globalism, go with deficit spending. It was his advisors. So it was, but we made some really bad choices in the 80s. Instead of basically saying, look, we can't allow, our budget to get out of control because if we do, that's going to destroy America eventually. In other words, we have to think in terms of our future. He left office, we had a national debt of 2.7 trillion in 8 years. So he added almost $2 trillion. And this is in the 80s. And now we're at 38 trillion. But he put it all in motion. But the key thing that Reagan did that was so dangerous, and the reason why I went into gold, was he was doing deficit spending when the economy was growing. And that is the absolutely worst time to do it. Economics 101 says, no, 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 you don't do that. If you really study economics, no, you don't do deficit spending. You only do deficit spending in a recession when you have to do it. And then you stop doing it. The second the economy starts growing, you stop doing it, you pay it off. That's what Keynesian economics was supposed to be.
Mm-hmm.
But Reagan said, oh, you mean to tell me we can do $250 billion deficits and it won't cause inflation and we'll get 4% GDP? Yeah, that's what's going to do it. And every politician since Reagan's been doing it. But now we're at the end of the line. Now the wall is right in front of us. And Trump's having, the big, beautiful bill with $2 trillion. See, that came out of the 80s.
Very interesting analysis there, Don. And I just finally like to ask you, for traders, investors navigating this landscape, what tips do you have for them right now?
Oh, yeah, great question. So, first of all, the bull market in the gold silver miners started in August. That's when silver broke out from $35. And that was kind of, if you go back and you look at silver, you look at the HUI. So this bull market is still early. I think it started in August for all three, for gold, silver, and the miners. And the winds that are back, I don't see a path over the next, 1 year to 2 years where gold doesn't go higher. I think gold will go higher for at least 2 years, and some people think it's going to go higher for a lot longer than that. But I project out at least 24 months. So if that's the case, if gold's going to go higher for the next, let's call it 18 to 24 months, that means silver will follow. If that's the case, that means we're going to get higher highs, higher lows, higher highs. So today we had, let's see, a 5% correction in the HUI. So your portfolio, we've seen our portfolios go up and down 3 to 8% on a daily basis. So uber volatility, but I think we go higher. So I always say you kind of ride the train, ride the volatility. We're going to ride this to the top. And so I see lots and lots of opportunity here over the next 18 to 24 months. So I'm extremely bullish, but I say that ignore the noise, ignore the volatility, if you will.
Mm-hmm.
Don't focus so much on 2026 because 2026 is going to be a volatile year. We've had this. I said we're going to have 5 corrections this year. This is the first one
Mm-hmm.
in February. I think we're going to have 4 more. And so in each correction is probably going to be, 10% to your portfolio, 10 to 30%, somewhere in there. But focus more on 27 because I think that this is the year the fear trade begins, and the fear trade won't kick into gear overnight. It'll pick up speed. But next year, I think in 27 is really the year. But we can get positioned in 26 and then really ride the wave in 27. You make most of your gains at the end,
Mm.
which I think is going to be 27, maybe 28. But in 27, I think you're going to have a decoupling where gold is up, the stock market's down, and money is pivoting into the miners because the miners are doing well. It's the only game in town. And so basically my point is use 26 to prepare for 27.
Love that. Out of curiosity, we talked about this, producers, developers, what direction would you point these investors as far as companies to consider in the gold and silver space?
I get a bonus question. Beautiful. When I was at VRIC, I spoke there and I said that the place you want to be is in producers, number one, and quality developers, number two, because those two groups have very strong elasticity to the gold price. And so they're going to participate in a big way. So quality producers, quality developers, that's where you want to be overweight.
Fantastic. Don Durrett, founder of goldstockdata.com. Thank you so much. Your insights are always empowering, and I just so look forward to our next conversation. This is really a pivotal moment for precious metals and the broader markets. And I want to thank all of you listeners and watchers, viewers, for joining us here on Stocks to Watch. And of course, be sure to subscribe for more market analysis and expert interviews like with Don Durrett. And of course, you can post a comment below. Thanks, Don.
Thank you.